Welcome to Your Money, Your Call. It's the Bond Show. It's the Friday night show. We don't like to be pigeonholed by bonds, so we could be the anything show tonight. I'm Mark Todd from the NAB. I'm joined by Richard Brandiviner who is the Chief Investment Officer from First State Super, and Roger Montgomery from the Montgomery Fund, and they're here to answer any of your questions. Feel free to call us 1300 30 34 35, and the email is yourmoney@skynews.com.au. Thank you for coming on. You've got a cold.
I do, sorry.
You're talking to children, high school students on their road to their HSC.
Yes, yes.
Were they nervous? Did you feel a sense
Yeah,
of...
they were very nervous, yeah. They were very nervous.
It's a sort of a culmination of years and years of endeavour. But to some extent, you know, you sort of think, I'm at the end of it. I've got to where my ranking might be. All I've got to do is just show up and I've done a lot of the work. I'm not really going to move it too much harder. And you'd think that would try and calm them down, but obviously it doesn't.
There's a lot of pressure. They put it all on that one day. That's the problem.
It just moves in. So thank you very much for coming on the show.
No worries.
And mate, you've just flown up from Albury?
Albury and Wagga.
Albury and Wagga?
Yeah.
What, you flew from both places? You flew from...
We flew to Wagga. We presented yesterday in Wagga and then drove down to Albury and presented last night in Albury, and then flew back. I had another presentation today with our friends at Magellan.
Yeah.
And then...
equity owners of
yeah, they own about 5% of Montgomery.
Just complete disclaimers here. We're just moving on to this thing.
Yeah, and then got back here just in time to see you, and you were very, very worried when I called to...
Yeah, I know.
Because you've got form.
You've got form.
But I always find a fill-in.
Yes, that's true. How's Wagga? Have they got rain? Is it lush or is it...
It is green. It's the greenest I've ever seen it. Flying into Wagga, it looks like France.
Yeah, right.
It's verdant. Yeah, it's amazing.
It's interesting when you think about where the currency's going. You know, the idea that the currency's going lower. And I've got this politician that comes on a regular basis, and people don't even ring up and complain, which is really unusual. But he's a politician that people don't do that. And
I've been on with him.
He's a good bloke, isn't he?
Yeah.
So Kevin was telling me that last time he came on, I said, what is it with the currency? Is it just that we've got a really nimble economy and we're responding to it? He said, well, yes, but also the world at large is looking for the cheapest price. And they're coming to you all the time. So if you've got lush land and you are producing, the world is coming to you saying, hang on, that's cheap, I'm going to buy that.
Yeah, well, the problem, of course, is that we've got a balance of payments current account deficit. We're living way beyond our means. We can't afford our imports from what we're earning from our exports, and so we need a capital account surplus.
Well, okay,
so
what's the answer?
The government spins it. Well, the government spins it and says, no, we need the foreign investment because they bring their intellectual property and, they bring their technology. Well, hang on a sec. If we actually had a surplus in the current account, we could actually be acquisitors. We could acquire the technology. We'd still get the technology, but we'd own it. And so, in answer to your question, what can you do to fix it? You really need to put in incentives for Australia to start new businesses to add value to our exports. And we don't. It takes 7 tonnes or 6.5 tonnes of iron ore to import one iPhone. We can't keep doing that.
And the Chinese are getting iPhones, so yes, we don't want that. How is business with you?
Oh, extraordinary. We've had, a terrific run in terms of performance. I noticed that we've just come to our 3-year anniversary on the Montgomery Fund. We ended up, over that 3-year period, we've captured 93% of the upside in any month that's gone up, and we've captured 46% of the downside in any month that's gone down. Right. So when a client approaches you and says, we want to go up with everyone else, but we don't want to go down with everyone else, well, I never thought we could actually deliver it, but so far we have.
So, okay, so year to date, do we look at year to date performance?
So to June 30, the last financial year, I think the market was up 5 or 6%. We did 13.5, and we did that with about 25% in average in cash.
You hold a lot of cash. And since June, is it worth this next quarter?
Yeah, look, it's been negative, but -2 or -3% against a market that's down considerably more.
Yeah, the market has obviously been well and truly hurt. And in terms of FUM, how much money do you have?
Just over 800 million now.
Yeah, nice. Starts with zero.
Starts with zero.
Yeah.
Always starts with zero.
Always starts with zero.
I really think the growth of, and without meaning to offend anyone watching, but I think the growth of the index investing industry is extraordinary, because you read Standard & Poor's index construction methodology, and the purpose of the index, they state what the purpose of the index is, and that is to track activity in the market.
Yeah.
It doesn't say the purpose of the index is to create long-term wealth for investors.
No.
It's about tracking activity. But somehow people think by blindly buying an index without reference to quality of businesses or without reference to valuation, they're going to be fine. And I just think that's wrong.
And when markets have been pretty volatile,
Yes.
how are the clients? You've just gone and seen, a whole bunch of customers. What was the general tone?
So there's two types of people that we talk to. There's the people that we feel we've done a good job of educating around volatility, and then there's everyone else. The people who understand volatility understand that it represents opportunity. And if we own wonderful businesses with great prospects, then a decline in price is a temporary issue, because the value of the business, the underlying intrinsic value of the business, is going to grow over time. What happens, though, of course, is all the studies, Dalbar, for example, in the United States, have researched this for 21 years, and what they know is that investors tend to buy at the highs. When the sparrow's singing spring's over, but that doesn't matter to them. They pay the highest price because everything looks good, and then they panic and sell out at the absolute bottom. And so volatility represents a danger to those people who aren't educated about what volatility actually is.
Been hurt. Did they go further?
Well, the most interesting spread's actually the spread between what the Fed is saying rates will be in 2 or 3 years' time and what the futures market is saying.
Yep.
Now, the futures market has traditionally got the yield curve very, very wrong.
Yeah.
It's almost 100%.
Traders who are nuts,
Exactly.
right?
I mean, it's 100% wrong. They never get the curve
they don't
right.
care.
So there's going to be some volatility around that readjustment, as they work it out, that it might happen faster than what they're predicting.
Yeah, so I don't know where rates are going. If I knew where rates are going, I wouldn't be working. But in truth, they're elevated. Will they go much higher? If the central banks don't want it to go much higher. So if you're thinking that they will get it right, well, then it's not going to go that much higher. You just got to work out, do you think the central banks can get it right?
Trading at a discount to their net asset values, and now it's making me nervous as to, is that a vote of no confidence on these managers? I mean, you're talking about big managers like the Magellans and Templeton Growth. So that was my question.
So Jess, this is your question could not be better, and I don't know whether you're related to Roger, but Roger knows this perfectly. So can you give an answer to Jess, because you are tight with Magellan, you've just been on trips with them.
Yeah,
you know what they're on about. So what's happening?
The first thing is Jess is comparing apples to oranges. So when he's in an index fund, an unlisted index fund, he's getting a unit price that always reflects the value of the asset. When he compares that to a global listed investment company, you're investing in a company, and the NTA of those shares varies by the performance of the portfolio, but the share price changes based on sentiment towards the stock and the manager.
You're right.
So Australian listed investment companies have been at a premium to intrinsic to their NTA for quite some time. And what I know, because I listed in a listed investment company many years ago, what I know is that goes in cycles. Typically, and over the long run, you would expect listed investment companies to trade at a small discount to their NTA, and that's because of the fees that are charged by the manager for managing it, and there's a lock-in period there. They often have a 10-year management period, or 3 or 5, or some of the older ones, 25 years. I listed one that had a 25-year management agreement. Yeah. So that's why it's not necessarily a vote of no confidence against the manager. It's a function of sentiment towards the sector, and also a function of the management fee that's embedded.
Okay. Why is that? They're just failing to provide guidance is not what they should be doing. 2
reasons. One is there's a bit of pushback from CEOs and CFOs. When they've given guidance in the past, they have to come back to the market and revise it. So by not giving guidance, it just makes their job easier.
Yep.
But the other part of it is it does actually look pretty uncertain for them. It's more uncertain than before. 3 big sectors of the Australian economy, resources, obviously no longer in a boom, and that's going to get tougher before it gets better. Then you've got manufacturing being hollowed out even more now by the removal of Ford and Toyota and Holden in Australia. We're going to lose potentially another 50-odd thousand jobs between now and 2017. So what do you have left? You've got construction. And construction is at record, we've got record approvals, record commencements, record completions, at the same time that population growth is starting to slow a little bit in Australia. In fact, in Perth, it's going backwards. So if you're trying to sell a property over there, it's much, much harder, and they're oversupplying commercial property. So it's uncertain. And then you've got China, of course, and that's slowing down. And we know, the numbers that they produce aren't genuine.
For my Chinese viewers, ignore him.
I'm sorry, I've spoken to Chinese viewers about this and they all agree.
We don't know. We can't confirm nor deny.
In a country as disparate as China is, it's remarkable that they get their quarterly GDP number out before the United States does. I think that's just
you must have been
incredible.
watching our show last week, because that's what Peter Jolly was saying. He was saying it was amazing that it takes us 2 weeks to get our data, and they can do it in about 2 days. And I hear that.
And without revision as well. They never go back and revise the number.
Oh, as long as you're consistently wrong, we don't mind.
Yeah, exactly. So anyway, so you've got all of those issues. You've got China slowing down a rapid rate of knots, which means resources could be a lot worse. And then there's the risk, of course, that people think Chinese buying of any asset, that they're geniuses. But have a look at what happened to their equity market. Have a look at what's happened to their commercial property market. Property prices over there in the commercial space down 50% as a result of oversupply. So them Chinese buying Australian real estate doesn't necessarily mean that Australian real estate won't go down.
We're going to buy a property at 5.5%. You really need that property to go up in value. But if inflation eats into that, or the person that funds it, the bank, says, you know what, I'm going to move that rate higher. Wow, you have no margin. You have no margin for error.
I've seen on the residential side, people are far less disciplined when they're valuing properties. So, we might say that was an expensive purchase or a cheap purchase, and in time will tell. But you can tell very quickly in residential real estate whether people are doing silly things. I saw a block of flats in Mossman sell for $3.5 million, and the gross rent was $130,000 on $3.5 million. So if you've borrowed any money at all, then after your interest, after your management, to a broker or a real estate agent, and then maintenance, you're not making anything. No. So it's pure speculation.
We've got another caller, Eric. Hello, Eric. How can we help you?
Oh, hi, Mark. Look, I wouldn't have thought Roger would have had this Western-style sort of jealousy of China, mate. Imagine America, if they'd hadn't printed 4 trillion, mate, what would have happened to their real estate and commercial market. My main question, though, mate, is on companies borrowing to pay dividends. I saw your mate Hamish, talking about Woolworths, but let's look at Wesfarmers. Over the last period, they bought back shares. I estimate average about $44 a share. Their share price now is $39. And I mean, from cash flow statements, there's no way they could have paid the dividend without borrowing money. Just thoughts on companies borrowing to pay dividends. Thanks, fellas.
Cool. So let's broaden it.
Sure.
The idea that in the US a lot of organisations are borrowing to either buy back their own shares or pay back dividends, and I don't see it as being. I mean, it was a GFC issue for the REIT market where they got that all wrong. My sense of it is, I don't want to talk about specifically about Wesfarmers, but my sense of it, I don't think it's a dilemma here. But it is interesting how they do it.
Well, the issue in the United States is that when you've got a global company based in the United States and it earns profits overseas, if it repatriates those funds, it pays tax. So a company like Apple, for example, keeps the money overseas. It's about, $346 billion.
$206 billion in cash.
There you go. So,
that's US
That's
dollars.
Aussie dollars, yeah. So you end up, and interest rates are so cheap, they can borrow the money to buy back the shares or pay a dividend. And there's no problem with that, provided the return that they're receiving on the money that they borrow is greater than the cost of that borrowing, right? They're greater than the cost of the funds. In Australia, they do the same thing to get rid of franking credits. Because if they've amassed franking credits, they want to pay those franking credits out, they'll sometimes borrow money in order to pay out more than what they've earned in order to distribute those franking credits, which of course have no value for an Australian company. But generally, what we see that concerns us more is when companies raise capital to pay down debt, because the return on that equity is only the interest rate on the debt. And that can often dilute the return on equity of the whole business.
You. chase for yield. So I want to know what you think about the fact that have we misunderstood the pressures of zero interest rates on the rest of the world? We've got it at 2. We're saying, you know, term deposits to 275. That's a joke. I want 475, whatever. Is the reality that the rest of the world is just scrambling for anything because it's such a hard world to invest in over there?
Well, they are, but I mean, where is the growth, the real growth coming through? You know, we're not seeing real growth anywhere. Even in the States, it's pretty anemic.
Yeah.
So while that's the case, this could go on for a while.
Yeah, between the last time interest rates were zero in the United States was 1932. Between 1932 and 1954, rates went from zero and peaked at 2.1%.
Yeah.
And that was a very long, and arguably the Fed got it wrong. They raised rates too soon in 1937, and then we had sort of almost a double dip depression again. Yeah. So rates stayed low. But Yellen doesn't want to make that mistake. If you read her,
that's exactly right.
If you read Yellen's transcripts when she was chair of San Francisco Fed,
yeah.
You know, she was a student of the Great Depression and what they got wrong in the late 1930s. She doesn't want to repeat that mistake on her watch. So they'll be very, very tentative about raising rates. Everyone's really panicked about rates going up. We're talking about 25 basis points at the most.
Yeah.
And then it could be a very long wait before we see another increase.
And one of the
taking it back to investors, though, investors have been focused on chasing yield now. What they really need to be focusing on is looking for the opportunity to grow income. You know, and that's not happening. So if you put $100,000 in Telstra 5 years ago, you know, that's grown to $132,000, and your income of $5,500 has grown to $6,500. Big deal. You put it in a company, a smaller telco, like, I'm just picking one, but M2 Telecommunications, for example, which has been able to retain profits and generate high rates of return on that retained equity. It's turned $100,000 into $3.5 million, and $3,500 of income's grown to $93,000.
Wow.
And that's what investors are missing out on by just going for the highest yield today. It might be that smaller companies that are able to retain some profits, grow off a low base, admittedly, are going to reward investors more fully.
But do you think that's more to do with the idea, because it's easy to be judgmental, but do you think it's more to do with the way portfolios are constructed? Because that role that Telstra plays in somebody's portfolio is actually...
What role is that? Just explain what that role is.
So they're taking that higher dividend because they want to live off that higher dividend. Now, I understand what you're going to say.
But okay, hold on, that income,
hold on, and then sell some shares, and you would have made all that money.
Sure,
but
that's another option.
But if all the people who bought Telstra bought M2, whatever you called it...
No, it's two. That's why I said not everyone's going to be able to do it because they're smaller. They're coming off a smaller base.
Yeah. So,
but what we need, and this goes back to a political issue or political question, we really need a tax regime that encourages the market to start businesses, to work out what we're good at.
So I think we're probably going to wrap it now, because we're actually going to change the election cycle. We're going to change the tax reform system. Leave the superannuates alone, because they've paid enough tax. They're all right. I want to thank both of my guests for coming on. It's been a really good show.